Week 10. Welcome back, Marathon Freedom Investors. Welcome back with another week. If you're new, subscribe. Um, Let me go ahead and say this before we start the video. This is all for entertainment. This is me coming on here documenting my journey to get to freedom by investing into the market with slow growth ETFs. And then when I get to my milestone, things will change. But let's get into it. The Dow Jones ended this week at 0.95%. The S&P index ended this week at 1.33%. The NASDAQ composed ended this week at 1.59. What put the pressure on all the sell-offs was easy. Iran pushed oil prices above $90, threatening the rise of global inflation. The Iran conflicts has driven prices past $90 a barrel in its highest weekly gain since COVID-19 pandemics in six years ago. So wow, that's huge. Another thing that caused the huge sell-off was the U.S. sheds 92,000 jobs. Woo! Water report was so weak. Wow. So the payrolls was negative 92,000 versus plus 60,000 expected. Plus unemployment rate rose 4.4% and unticked from 4.3% in January. So stocks are falling due to economic release and fears of a broader war in the Middle East, obviously, and the Fed angle slim odds of interest rates cuts in the first half of the year. So there's a slim odd of an interest rate cut in the first half of the year, just because of all the volatility that's going on. So where does that lead us? In the fear. So the fear dropped down to 27. It previously closed on Friday at 33. A week ago, that Friday, we ended at 38. Now we're at 27. Buy. That's what Kramer would say. Correct. Um, Here we are, second week of March. The biggest mover that I see is the consumer price index. And the consumer price index is very important. Why? Because high CPI means Feds may raise interest rates and cool inflation. Low CPI means Feds may cut rates to stimulate the market. And how does that directly affect us? Mortgage rates, credit card rates, car loans, business loans. If the CPI can cause the Feds to cut rates, it can help small businesses, which can help the market and things like that. So it plays a huge role in the way we measure the urban consumers, about at least 9% of the population. So let's go to the earnings this week. Do we have any big movers like we had last week and a week prior with like Broadcom, Nvidia, Tesla, stuff like that? No. The only ones that I see that a lot of people are probably going to be interested in is Oracle, right? Which will be that Tuesday. Um, HPE, not a bad. Packard's, Enterprise. I'd like to see what they got going on. Oracle, obviously, everybody's going to be tuning into that. Serve Robotics, see if they get a bump back up. iPath, everybody's going to be interested in that. And Mumu, right? See what Mumu do, which is the FUTU, if you didn't know. Ultra Beauty, that's another good one. So these are your weekly earners. Your weekly earnings coming in this week in March between the 9th and the 13th. I think Tuesday will be big with Oracle. Everybody's going to be on the edge of the seat on that one. All right, let's get to my account, right? This is going to be the weekly retreat. The weekly treat. I'm going to go ahead, get right to it. You see, we have 4 red days this week, 1 green. The third was it went down like maybe like 1.5. When I seen that, I went on ahead and put in my weekly deposit that I usually put in the market, and I also thought that this was going to be pretty. I thought the third was going to probably be one of the lowest days in the market because it was like 1.5, 1.6 when I put it in. So I put the $500 in there, not knowing that Friday was going to be worse than Tuesday. So I ended up putting $577 in the market. But regardless, DCAing, whether it's green or red, the money's going to go in there every week, every month, throughout the year. It never stops. We DCA. I'm going to hold these stocks for the next 5 to 10 years unless the fundamentals change of these companies. Um, this show proof, March 3rd, 2026. These are when I went ahead and implement my money. You can pause it, look at it, and see how I did it. Let's go ahead and go to my positions. We're going to run through the positions. I'm just going to go ahead and close up the video. SMH, which is my semiconductor ETF, right? Powerhouse. But I have invested in it, which is 10% of my position in my portfolio. I have $619.33. And what it's worth right now is $585.35. I have 1.53836 shares of the company. The last close price was $380.50, and my average price of purchase is $402.59. VXUS, which is my international stock ETF, my average cost, which is 10% of my portfolio, is $619.29. Right now, the price of the stock is $592.39. The average price of purchase, where I purchased it at, is $80.98. And when it last closed that Friday was $77.72. And I have 7.64788 shares of VXUS. Next stock will be VOO, which is the S&P 500, which is a broad market ETF on the Vanguard side. My total cost of what I have invested in it is $2,807.95. What it's worth right now, the market cap is $2,752 and 91. I'm sorry, 2,752.91. My average purchase price is $630.10, and what it closed at was $617.75. And I have 4.45635 shares of VOO. And last but not least, is SPMO, which is my momentum ETF of the. If I'm mistaken, it's the top. It's not even mistaken. It is the top 100 companies in the S&P 500. I will do probably the next time I come on here. I'll give a bunch of fun facts about SPMO on how it operates. If you're interested in it, um, well, this is 30% of my portfolio. I have $2,146.39. Right now, the market of what it's worth is $2,138.54. My average price of purchase is 118 and 73 cents, and the last close was 118 and 30 cents. And I have 18.07724 shares of SPMO. Guys, uh, my portfolio is growing based on the funds that I'm putting in. I'm not really getting any growth from the market as of right now. I'm happy with all the ETFs that I own, because in these conditions right now, this is the prime example of why you do not want to be invested in a particular company with all the volatility going on. Because just imagine if I was investing in like Microsoft, Google, Tesla, and a bunch of other small companies, my portfolio would be down way more than what it is, based off of the volatility that's going on in the market with the war, the gas prices, the uncertainty, capex, et cetera, et cetera, et cetera. So that's why I strongly preach you should be building a foundation before you start exploring into growth stocks. Um, Other than that, thank you, thank you for listening to my entertainment on YouTube. I am not a financial advisor. I'm only here to share my experience, my journey of slow growth in this portfolio. And like I said, thank you. Get down and subscribe. Get down in the comment section. Let me know what would you guys do different? What should I do to protect myself from all this volatility? And I will see you guys next time. Peace. Thank you.